It's great to have you, as always, a day later than normal, but nonetheless, it is so good to have you for your perspective, and maybe better. You've had 24 hours now. Take it all in, right? You heard what Powell said.
Yep.
You read what they did. They cut their growth outlook. They take their inflation expectations up. And maybe most importantly, for the way the market viewed everything yesterday, they kept 2 cuts for 2025. But you've had the time now to think about it. What was your takeaway?
Well, the word of the day certainly was uncertainty. You know, he said it so many times, and you can't really blame him. I mean, obviously, April 2nd is looming. It's not very far away at all. And we have to see what happens with the tariffs. The one thing Powell said that I think the market liked a lot, I think there's no inkling of tightening. I mean, he still has 2 cuts on the dot plot, which is sort of strange because there was a lot of pushback from the reporters asking questions like, what is this about these cuts on here if you're upgrading your inflation? And it's a good question, but Powell was very much on the defensive, I thought, yesterday. But the market obviously liked the fact that there's still 2 cuts in place. And you can kind of see why. The 2-year Treasury is down a little bit under 4% now, which is quite in sync with a couple of cuts. They did downgrade growth to 1.7 real growth for this year, and they upgraded inflation, depending on what index you look at, to about 2.6, 2.7. But if you take the 1.7 and add on that inflation rate that's predicted, you're right at about 4.3, 4.4, which is sort of where the 10-year Treasury is. So he used the word, in addition to the word of uncertainty, he used the word inertia, which I thought was a really interesting word. I think he only used it once, but it's an interesting word. It kind of says that he doesn't really know. He said nobody has high confidence in their forecast right now because there's too many moving pieces on all of this. But since the Fed started cutting rates back in September, bond yields are still up, and the stock market is really doing very, very little since then. So this is an unusual time period where the Fed cutting rates by 100 basis points and talking about 2 more. We have not seen a rally in the 10-year Treasury bond. The price of the 10-year Treasury bond is down, and we have also not really had a rally in stocks since the Fed started cutting interest rates. There's that old phrase, don't fight the Fed, which is supposed to mean that if the Fed's cutting, you're supposed to stay long risk, but it sort of isn't working this time. And I think that's going to continue to be a theme as we move forward in time. I think that we have a really big problem with, and I talk about it every time we meet, Scott, with this interest expense. You know, it's over $3 billion a day in interest expense on the Treasury debt. And it's interesting that the Fed has cut back quantitative tightening down to $5 billion a month. I wonder why they didn't just go to 0, quite frankly, because $5 billion a month isn't even 2 days of interest on the debt. So you're really into the rounding category. But one of the reasons I think they did that tapering of quantitative tightening is I do think that there's a desire to have interest rates go down. And one of the ways you do that is by having less, quantitative tightening going on. So all in all, I think it's a wait-and-see situation for sure. And it is interesting that the Fed did give the market the idea that the tariff thing might not be an ongoing escalation problem. It might just be a one-time on the inflation rate. I thought that was a little bit surprising that he was so clearly stated on that one. And so we'll see if that happens or not. But it would seem that the inflation rate is going higher. Our inflation model agrees pretty much with the dots that the Fed has for this year of about 2.75% inflation rate. It'll be a little bit, it should be fairly calm in the next couple of months, except for the tariff effect, which nobody really knows what the answer to that's going to be. So since this cutting cycle began, not a lot of money being made out of financial assets. What's really working are the real assets. The commodities are up, gold is up a lot, and Bitcoin, which is really, right, gold above 3,000 and holding now. And Bitcoin, is just gold on leverage, really, the way I think about it. And so, of course, it's up the most since the Fed started cutting rates. So the 10-year Treasury rate is the same as it was 2.5 years ago, and the range on the low end was 3.6 and the high end was 4.8, and we're pretty much in the middle of it. So this is kind of a grinded out type of a market. The one thing that has happened, and I think that, you know, people say that bull markets climb a wall of worry. I don't feel like we have a wall of worry quite yet. I keep hearing things that are kind of explaining things away. Like Fed Chair Powell said, you know, the break-even inflation rate is above 4. There's a University of Michigan, I think, survey that's shot up to 4.5 for the next 1 year inflation. And he chooses to downplay that by talking about the 5-year forward, which for most people isn't even really a thing. You know, it's the prediction of what the inflation rate will be 5 years from now for the 5 years subsequent to that. So it's an inflation rate that's way out there. I don't understand why anybody thinks they have a handle on that. But the 5-year forward has been relatively stable, while shorter-term inflation considerations have been upgraded. And so I think that we're in a very stable place. I like the word inertia. We're in the middle of the trading range. Spreads have started to widen on credit, though. That's the other thing. So if Powell chooses to talk about 5-year forward and downplay near-term inflation, and I hear a lot of people saying, well, stocks had a quick 10% drop, but credit spreads have been really well contained, well behaved. I don't really think that's an accurate characterization. It's the junk bond spread is got out by about 70, 80 basis points from what its narrow was last year, and that's not insignificant. And also the VIX, while it's come down in recent days, it's still very elevated. And if you overlay a chart of high yield spreads, the incremental yield on high yield versus treasuries, with the VIX, there's a very high correlation there for pretty common sense reasons. But the high yield spread looks on that chart that it should be widening more as we move forward in time. So I think there's a lot of downplaying of risk that's become evident in the market.